This is Agriculture Today, and I'm Shelby Varner with the K-State Radio Network. A cattle market update from Tyler Cozzens, Director of the Livestock Marketing Information Center, begins today's show. He reviews the recent trade and cold storage reports. Keeping today's show moving is Jenny Ifft, Flinchbaugh Agricultural Policy Chair, discussing finished price discovery for crop insurance. K-State Wildlife Specialist Drew Ricketts ends the show, explaining how prescribed fire is beneficial for wildlife populations and what has the biggest impact on species. That and more is coming up ahead on Agriculture Today. You're tuned in to Agriculture Today, and we start our Monday show with a cattle market update from Director of the Livestock Marketing Information Center, Tyler Cozzens. Tyler, thanks for joining us today.
Thanks for having me on. I appreciate it.
Tyler, last week we saw a report involving trade data, and what were we seeing?
Right. So we got some more trade data information last week from USDA at the early part of the week there. And the key part of that to note is that actually was December trade data. So that finalized our annual trade statistics for 2025. So we can start to make some comparisons kind of on an annual basis. So that's what I'd like to discuss now. So kind of starting off with some of that trade discussion, looking specifically at the live cattle trade side of things, right? That's been one of those that's kind of been in focus here in 2025. And so cattle imports were actually down substantially from last year, not surprising. So in 2025, U.S. imports of cattle actually totaled just under 1 million head. Is actually 981,000 head and some change. That's actually down 52% or about 1.1 million head from last year. So substantial decline there. A lot of this decline was driven almost entirely by a closure of the Mexican border due to New World screwworm in Mexico. So kind of looking at the two main sources for our cattle imports are Mexico and Canada. So Mexican imports of cattle in 2025 were down 82%, or just over 1 million head to 229,000 head. Canadian cattle imports were down 6%, or 46,000 head to 752,000 head. The lower imports will continue in 2026 as the border to Mexico is expected to remain closed. Now, switching gears, looking at exports, the U.S. exported just over 500,000 head of cattle last year, actually 550,000 head last year. Most of those went to Canada. 492,000 head went to Canada. That's actually an increase of 23% from last year. And I think a quick note on those exports to Canada, most of those went in the fourth quarter to Canada for placement into those feedlots there. Exports to Mexico were 11,000 head. That's actually down 11%. Now, looking at the hog side of things, hog imports are almost entirely from Canada. So in 2025, we imported nearly 7 million head from last year in 2025. That's actually up 3%, or about 230,000 head from 2024. Now, of the hogs imported from Canada, about a quarter of those hogs, 24%, weigh over 100 pounds. A lot of those are market-ready hogs or cull sows to get slaughtered. But that remaining 3/4 of those hogs that are imported from Canada weigh less than 100 pounds. And most of those are going to finishing operations kind of in the middle part of the country to get fed out to a market weight. Now, kind of switching over gears here and talking more about the meat trade statistics in 2025. Kind of want to start off some of the discussion on the beef import side of things. Been a fair amount of discussion on that side, but kind of looking at some of those top suppliers of beef into the U.S. Australia came in as that top supplier, just over 1.4 billion pounds of beef imported from Australia in 2025. That's actually a 27% increase from the prior year. Imports from Canada came in about even with a year ago, just over 1 billion pounds. We saw a large increase from Brazil, 931 million pounds imported. That's actually a 35% increase. Now, a few other key ones to talk about. We saw an increase from Mexico as well, 19%. New Zealand actually decreased 4%. But one that's been in the news a fair amount is actually Argentina. And so we did see a 30% increase in beef imports from Argentina. But one of the things I want to point out is we look at some of these beef imports as far as the percentage of beef that was imported from each of these countries. 2% of the beef that was imported in 2025 came from Argentina. right? Australia, now we look at that, the top importer, 26% of the beef that we imported in 2025 came from Australia, right? So, Australia and Canada and Brazil were largely those main suppliers of beef in 2025. So overall, total beef imports came in at just under 5.5 billion pounds, actually an increase of 18% over 2024. Now switching gears here and looking at beef export side of things, beef exports were actually down 14% to just under 2.6 billion pounds in 2025. Key thing to take away there, South Korea and Japan are kind of those key markets that we export to. Just about half of our beef exports went to those two markets. Actually, South Korea stayed about even with a year ago. As far as beef exports go, Japan was down 5%. But from a export standpoint, right, lower beef supplies here domestically and higher prices, still seeing a lot of that trade flow go to those key markets is critical for us, just from a domestic price standpoint, supporting those prices. Now looking at the pork side of things, pork exports were actually down just over 2% from a year ago. They almost hit 7 billion pounds in 2025. Not surprisingly, Mexico was that key destination for us. 40% of the pork that we exported in 2025 went to Mexico. Pork exports to Mexico actually increased 6% to just over 2.8 billion pounds. So a key market for us there on the pork side of things is Mexico. So maintaining some of that relationship there and just trade flow is going to be key for this pork sector. Quick note on the pork import side of things, those actually fell to almost 3% last year. A lot of those declines came from just Canada as kind of that main supplier for us for pork. That actually declined about 1.5% from a year ago. Looking a little bit more at the red meat side of things, on the lamb side of things, so let's kind of keep an eye on that, just kind of from a Western perspective. But lamb imports were actually down about 2% to just over 300 million pounds there in 2025. Australia and New Zealand are those key suppliers for us, and most of those declines came from those two markets there. We did see an uptick as far as mutton imports in 2025, actually up about 25%, but that's all kind of relative because it's 69 million pounds of mutton imports there in 2025.
And Tyler, what are we seeing when it comes to cold storage?
So one of the reports that we're looking at that's kind of those key reports from the supply side that we always keep an eye on is cold storage. So keeping in mind when we look at cold storage stocks, what we're looking at is to see if supplies are increasing or decreasing from last year, and if we're seeing any seasonal patterns that are changing, right? So depending on how cold storage supplies are trending, this could have price implications in the near term. So let's look at some of these cold storage statistics. So kind of looking at a big picture discussion here, total red meat and cold storage stocks as of January 1 were reported down nearly 2% or 18 million pounds from last year to 863 million pounds. So kind of looking at this a little bit more disaggregated at the beef side of things, total beef and cold storage on January 1 was actually down 4%. That's about a decline of 20 million pounds from last year to 435 million pounds. A lot of that decline came in just lower stock levels for boneless beef, actually declined 5% to 395 million pounds. We did see a slight increase of 6% in beef cuts in cold storage. That's to 40 million pounds. But kind of the lower all beef stocks is not unexpected given the lower production that we're seeing. But keep in mind that, or keep an eye on stocks this year. Will be one of those things that we watch just to kind of gauge the overall demand profile here domestically. So kind of an increase in beef stocks would suggest that we might be seeing a slowing in demand in the retail and consumer levels. Now, kind of switching over here to pork stocks. Pork and cold storage was actually reported at 410 million pounds at the start of January, which was up 1% compared to the prior year. Most of that increase actually came from higher stock levels for bellies, hams, and ribs. We did see a decline in loins and picnics and trimmings compared to a year ago. Now looking at lamb and mutton, kind of rounding out that red meat and cold storage discussion there. Lamb and mutton in cold storage fell 6%, or about 1 million pounds to just over 17 million pounds at the start of January. Kind of as a side note, on January's lamb and mutton stocks were the lowest monthly level in more than a decade, when stocks actually dipped below 17 million pounds in December of 2011. So a pretty good dip there in the lamb and mutton stock side of things. Now switching over to the chicken side of things, on January 1st, chicken stocks were down 2% to 771 million pounds. That decline was driven by lower stock levels for breast meat, drumsticks, leg quarters, and wings. But we did see a slight increase there in thigh quarters and thigh meat, which increased 15% and 11% respectively to 9 and 18 million pounds in January. And lastly, on the chicken side, whole chickens fell 1% to 795 million pounds in January. And kind of rounding out some of the discussion on the poultry side, turkey stocks fell 8% to 238 million pounds in January. A lot of the decline in the turkey stocks was driven by breast meat and legs, but we did see a 7% increase in whole birds in cold storage, which actually came out at 104 million pounds. On the dairy side of things, with the exception of butter, dairy stocks saw year-over-year gains for each of the reported categories. Butter stocks decreased 17% to 215 million pounds. American cheese increased 3% to 792 million pounds. Swiss cheese increased 1% to 23 million pounds. And other cheese increased marginally, or about less than 1% from a year ago, to 565 million pounds. So overall, cheese stocks increased 2% to nearly 1.4 billion pounds at the start of January. So to kind of summarize some of this discussion on the cold storage side of things, cold storage stocks on January 1 were tighter than a year ago. For red meat, supplies were also tight for chicken and turkey stocks to start the year. So as we start 2026, red meat stocks will be the item to kind of watch, as these tight stocks will become a factor in the supply picture, which will factor into meat prices at the retail meat case.
Tyler, I appreciate you taking the time to join us today.
Thank you for having me. I appreciate it.
That was Director of the Livestock Marketing Information Center, Tyler Cozzens. We're cutting to a short break now, but we'll be right back. You're tuned in to Agriculture Today, and we continue our show discussing price discovery and crop insurance with K-State Flinchbaugh Agricultural Policy Chair, Jenny Ifft. Jenny, thanks for joining us today.
Yep, thanks for having me.
Jenny, as we're talking about crop insurance and price discovery, why is that?
Well, if we take a step back, most crop farmers in Kansas are going to insure their crop with a product called Revenue Protection, RP. And that sets a revenue guarantee, or you could think of it as a minimum revenue or a revenue floor that's based on two things. One is market prices, and two is that producer's own yields. So crop insurance deadline is March 15th. And so what's used to set that guarantee? Expected prices and expected yields. Expected prices are based on futures markets, specifically the futures market prices for harvest during the month of February. So that's what we call price discovery. That's the period in which we figure out what actually expected prices are. That's over now. So producers already know their expected yields. That's your APH, average production history, or your approved yield in crop insurance lingo. So now you know what your revenue floor is for 2026. You can also start getting final premium quotes and start thinking about making your final crop insurance decisions for this year.
And as price discovery has come to an end, what are we seeing?
Well, really not too much change. I did go back and look at the data from 2023. So we're going to focus on corn and soybean spring planted crops. Grain sorghum prices are tied to corn, so they're about the same. So I'm just, for simplicity, I'll be discussing corn and beans. First of all, corn, if you go back to 2023, corn was $5.91 per bushel. That's almost $6. But then over the past 3 years, starting in 24, it's been $4.66, $4.70, and $4.62. So, it hasn't changed too much in the past 3 years. We can look at soybeans. It's $13.76. It went down to $11.55. In 2024, it was $10.45 last year, and it went up a bit this year. We had a price rally. It's $11.09 per bushel. So it's not any huge changes. And how you look at that, it could be glass half full or glass half empty. It'd be nice to see some stronger prices, but it could be worse.
Do you feel like we're ever going to see stronger prices when it comes to this?
Well, like a good economist, I can say it depends. But what I will tell you is prices always go up and down. So we will eventually. The question is just when. But, those revenue guarantees, that revenue that crop insurance is protecting, it's going to be the same as the past few years. So in some ways, it's a familiar situation.
What's next for this?
Well, one more thing, small point here, but in this economic environment for crop farmers, every little bit counts. So you collect prices during price discovery. You also collect something called implied volatility. So implied volatility is a measure of the movement of prices, of future prices. So, the volatility, the changes in the market. So if the market is uncertain, it's moving up and down a lot. That's higher volatility. That means it's more expensive to insure something. Your crop insurance prices go up. We did see implied volatility go down this year. So it was 0.18 for corn. It's 0.15 this year. So 0.18 last year, 0.15 this year. Those numbers, they're a little bit hard or at least not fun to interpret. So I tried to get it into dollar terms. So for your higher value crop insurance policies, it might be $1 lower, all else held constant from last year. And just, every little bit helps right now.
And as growers are thinking about these different decisions and maybe have done the same decision for multiple years in the past, what message would you like to send with them about keeping the same or maybe changing it up?
Right. Well, risk management, that's a really personal decision. But we can say that, things have been tough for a while. You're looking at a third year of tight profit margins. At best, it's worse for some, but tight profit margins for crop farms. So, if you do, hopefully, farmers at least have a thin profit margin this year, but that profit margin is precious. So it's important to protect it, but paying the premium, any premium is going to be even more painful, especially in the input cost environment. When I talk to folks, a lot of times I say, your typical crop insurance guarantee in Kansas, we do about 75% revenue protection. You're protecting 75% of what's expected. That's not going to cover expenses for a lot of farms. So that, risk management decision is as important as ever, and it's maybe perhaps more painful than usual. So there's one thing that's new and one thing that's not new. What's not new is that one way that you could increase your crop insurance guarantee, maybe save some money, is through risk pooling. And there's different ways to pool risk. So if you could think at the most basic level, you can insure at the field level or the farm level. That's, in crop insurance lingo, that's going from optional to enterprise units. If anything goes wrong in that field, you get paid. You have a hailstorm, it just hits one field, you get paid. At the farm level, you're using enterprise units. You're sort of pooling the risk across the farm. That affects the cost. So enterprise units are typically much less expensive. Personal decision based on how you want to manage risk, but there's some real trade-offs with lowering costs. You also have the county-based supplemental policies. Sometimes I refer to these as high coverage policies. There you're pooling risk at the county level, but it is a more affordable way to get a higher guarantee, to get more risk protection. Now you have something new called CLIP that pools risk across crops at the farm level. So a lot of options, and these are really something to discuss with a crop insurance agent. But that is a way that you can manage your costs and maybe get more protection and balance stuff. So those principles have not changed. But what has changed is the prices. So the One Big Beautiful Bill Act was passed in July, and it lowers premiums for most crop policies. But it doesn't lower them all the same. So there's a modest decrease in the cost for your underlying policies, so your revenue protection policies. So those are going to go down. There's a much larger premium cost decrease for the high coverage policies. They're going down a lot. So what we're encouraging people is that, the environment has changed, the relative prices have changed. If you want to rethink what you're doing, now is an especially good time to do it. And with crop insurance, there are hundreds of choice. There's a lot of ways you can slice and dice it. We could never cover them in a radio program, or Shelby, you might quit if I tried to do that. But the good thing is it's crop insurance agents, and that's their job, to help producers maybe, boil it down to a few different options where you could understand the trade-offs and make a decision that best fits an operations, goals, whether it's a cost goal, whether it's a revenue goal, whatever makes the most sense.
Can you remind us, what is that deadline when it comes to crop insurance?
It's March 15th.
So, Jenny, while we have you on for Ag Today, any news or what are you seeing when we look at ag policy for the agricultural industry?
Well, I'm going to stick to policy when you ask that. So we're in an ad hoc era of farm policies. I think that's one of the defining challenges for the farm safety net right now. We're in a situation where we have fairly large supplies of crops. They're low prices. Prices aren't historically low. We have not great prices and high input costs. So it's a tough situation from a policy perspective, because there's getting to have large supplies, low incomes. We've been here before, and it's a tough situation for everybody. I think most farmers will tell you they'd rather have higher market prices than these programs, but they can make a big difference in times like this. So that's one of our defining challenges. Will we get out of this? So one question is, the One Big Beautiful Bill Act, it increased the prices, the support provided through agricultural risk coverage and PLC price loss coverage. We've talked about that before. We're expecting pretty substantial payments, especially for grain, sorghum, and wheat come October. So is that increase, going to be enough to get us out of the ad hoc era where, ad hoc payments, they come as planned, they can help, but they're also unpredictable. So how do you put an ad hoc payment into a crop budget? How do you make input decisions? How do you make investment decisions in this policy environment? So, will we get back to more policy stability? That's one of the big questions I have. A lot of questions with the Farm Bill right now too. So there's, different farm bills. The House has marked up a farm bill. The Senate's going to do it now. Those have been put out there. They're being debated. And there's some debate whether we'll get another farm bill or not. Although I'd say we are in new territory. We've had 3 extensions of the 2018 Farm Bill. One extension is super common. You've had 2 extensions before. This is the first time we've had 3 extensions. And nobody's saying, I haven't heard people being super optimistic that we'll get a new farm bill, especially coming up to a midterm year. So then you're looking at a 4th year of extensions. And part of it is the One Big Beautiful Bill Act. It strengthened the farm safety net, and it cut back or reformed nutrition programs, depending on how you feel about that. And so, there's been a breakdown of the Farm Bill coalition, but nobody really knows what it's going to look like moving forward. So I think there's a lot of uncertainty with the Farm Bill at this point.
Jenny, I appreciate you taking the time to join us today.
Absolutely.
That was K-State Flinchbaugh Agricultural Policy Chair Jenny Ifft. We're now cutting to a short break on Agriculture Today, but stick around because we have more for you up ahead. You're tuned in to Agriculture Today, and we conclude our Monday show discussing prescribed fire for wildlife. And to talk about it, we're joined by K-State Wildlife Specialist Drew Ricketts. Drew, thanks for joining us today.
Yeah, thanks for having me back, Shelby.
Drew, a lot of times when we think about prescribed fire, we think about it for cattle management, but what does it do for wildlife management?
Yeah, so really when we're thinking about wildlife habitat management, prescribed fire is the cheapest management practice that we can do in any ecosystem, and really most ecosystems throughout North America are adapted to have prescribed fire in them. It's really important from the perspective that ecosystems want to go through this process called succession, where we start maybe with bare soil after a big flood, or we till an area or something like that, and then we get the annual weeds, and then we transition to perennial plants and maybe perennial grasses and shrubs and early successional trees like cedars and elms and that sort of thing, and on into a climax community that might be in eastern Kansas oak trees, it might be cottonwood forest in western Kansas, and that prescribed fire helps to set that process back or slow it so that we can maintain a plant community that critters might want to have. So maintaining prairie is a really important important thing that prescribed fire does to us by setting back those woody plants. We can see some invasive species management too on the plant side of things that's important for wildlife. And if we're thinking about a critter like deer, when the fire top kills a woody plant out there, the new growth on that woody plant is going to be really nutritious and easy for them to digest. Other things to think about, especially when we're burning for livestock management, but really for any sort of prescribed fire, those small areas that might escape the fire that don't get burned, like an area around a strip around a cattle trail or an area in a drainage or something, even though we may want to go back and clean that up and burn it later, having a few of those around is good. Those are going to be like the nesting spots for quail because they need some residual grass growth to nest in, but also need burned area right next to it. Other things about removing trees that are good, quail are a species that we strongly associate with brush, but the more research we do on that critter in grassland environments, the more we figure out that trees and quail are not all that good together. Quail survival tends to be pretty low when we've got very many trees around in a prairie. So even though they like shrubs, we want to especially use that fire to help reduce the tree cover in the area and those sorts of things.
Do you have any mortality concerns for wildlife when it comes to prescribed fire?
For the most part, no. The species especially that are in prairies where we tend to have the fast-moving fires that might be hard for a critter to escape, they have adaptations that allow them to get away from fire, like being able to fly or being able to run fast, or being maybe a burrowing species if it's a rodent that can get below ground. The later we burn in the spring, or sometimes a growing season fire during the summer, we can see some mortality of snakes and turtles if those critters are out and about because it's gotten warm enough. We can see a little bit of mortality of critters like cottontail rabbits and some of the different species of rodents that may be in a prairie. But as a whole, even though that one fire event might harm some individuals, it's good for the species as a whole and the population as a whole because they depend on that prairie or maybe an early successional state of forest if we're talking about fire and timber and that sort of thing. So it's good for them in general, even though it may harm an individual or two.
So even with that little bit of potential harm, does timing make that big of a difference when we look at the overall picture for wildlife?
Not really. Some important things to think about for wildlife are it tends to be best not to burn very, very large areas all at the same time or all in the same year. So burning part of a pasture one year and part of that same pasture the next year so that we were always burning something but not burning the whole thing every year. When we're thinking about timing within the year, really, if we're thinking about wildlife, the best time to burn is when you've got the right weather conditions and the crew to get it done. So just getting fire on the ground is much more important than being so concerned about having the timing right that we don't ever get it done.
Drew, I appreciate you taking the time to join us today.
Absolutely. Thanks for having me, Shelby.
That was K-State Wildlife Specialist Drew Ricketts. That's all we have for you today on Agriculture Today, but we'll be back with more for you tomorrow.